Hey guys, Rich DiGiovanna here with the DiGiovanna Realty Group and Remax Allegiance, and I have the real pleasure of introducing one of my favorite lenders. His name is Keith Brown, and my name is Rich DiGiovanna. Keith, tell me a little about your business, who you work with, and how you got started in the lending business.
So again, Keith Brown with Intercoastal Mortgage. Been doing this since December of 1995, so going on 28 years of mortgage lending. Pretty much this is all I've done since I graduated from school. I had an uncle that was in the business, worked for a company called BF Saul Mortgage, the old mortgage company for Chevy Chase Bank, and he got me on the ground floor and took off from there. The company I'm with right now, Intercoastal Mortgage, I've been with them for a full 26 years, so the better part of my career has been with this company. What sets Intercoastal Mortgage apart from a lot of our competition is that we're a direct lender. What that means simply is that we control the source of funds. We underwrite, we process, and we fund the mortgage. Everything is done out of our office. The file never leaves our possession. And that allows us to control the process from start to finish, avoiding delays, avoiding surprises. And obviously, I very much enjoy what I do, and I've been with this company a long time, so I do think this company is very good at what we have to offer.
That's great, Keith. And one of the reasons I love working with you is, and it's so important to get every buyer out there pre-approved,
Absolutely.
not just pre-qualified, but pre-approved. And tell my audience why that's so important.
So pre-approval is incredibly important because the mortgage industry is constantly evolving and guidelines are constantly changing. And the biggest thing is, you'll be amazed the number of people that I work with that have no idea what their credit looks like, have not looked at their credit, or they're surprised when they see something on their credit that they weren't aware of. A true pre-approval involves actual documentation. It involves me looking at someone's credit report, all three bureaus. It involves me verifying the income. I've had plenty of clients say, well, I make this, and I look at their income documentation, and the income's different. Sometimes people think income being only net income. We use gross income before deductions for qualifying. Other times, I might have a client that's self-employed and say, hey, I make X amount of dollars. I look at their tax returns and they have a loss because they're writing everything off. So the documentation part of it is the most critical part. The other thing is discussion on where the fund's going to come from for down payment. Believe it or not, mortgage lending, because a lot of it follows federal mandated rules, they're very concerned with money laundering. Mm-hmm. So a lot of people don't understand that we have to verify where that money's coming from to avoid any concerns with money laundering. Money laundering is simply using an asset such as a house to run funds through that might not necessarily have come from acceptable sources. So that's why when someone says, hey, I'm going to put down $100,000. Okay, well, where's that $100,000? Is it your bank account? No? Okay, well, is it in a 401k plan? Are you borrowing against retirement assets? Are you liquidating investments? You know, are you getting gift funds from a relative? Is it gift funds from a non-relative? And there are requirements on all of these items. So as part of my discussions with the client in a pre-approval, we're going into all these aspects. Now, obviously, for the client's perspective, it means that when I say they're pre-approved, they know they can go out and search for a home. They know that when they write that contract, they can start making their moving plans. They can start changing, if they have children, changing their schools, setting up utilities without any surprises or issues or gotchas, basically. From a realtor's point of view, do you really want to put someone in your car, show them 30-something homes, write several contracts, only to find out that these people weren't qualified properly? Yeah. I can't tell you how often I've seen folks come in and say, well, I've been pre-qualified by my bank, and you find out all the bank did was run a credit report and had a phone call conversation. Never looked at the income, never looked at the assets, and then something blows up in the middle of the transaction. Most times that's where you hear these horror stories. Yeah. Since my business is 100% referral based from realtors like yourself, I want to make sure there's never a deal that blows up. And because you're not going to refer me business if a deal blows up. You're not, my realtors won't refer me business. And if a client has a bad transaction with me as their lender, and you referred them to me, well, they're not going to refer other friends and family to you to buy homes.
Absolutely.
So the pre-approval process is critical, not only for the client's peace of mind, but also for the realtor's peace of mind.
Yeah. What I love too, Keith, the best part about working with you is when I feel like I can go to bed at night knowing that my buyers are fully approved.
Right.
The only thing we need to do is find a home,
Absolutely.
give you the address, and we're done. And you can't do that with a lot of lenders.
No.
And one of the things I like too about you is you really understand the underwriting guidelines, which if you're working with a lender that really isn't close
Right.
with the underwriter, and explain to them what the underwriter does in this whole process.
So the underwriter's job is to make sure the loans conform to wherever we're placing them, whether it be Fannie Mae guidelines, Freddie Mac guidelines, FHA, or VA.
And why is that important?
Because each lender of each of those institutions have different guidelines. For example, FHAs will take much lower credit scores, and FHA will also take much higher debt ratios. But on the flip side of that, FHA is much more concerned with source of funds for closing. FHA also has some quirks where there are certain debt ratios you can't exceed based on certain circumstances. FHA, for example, also requires, just to give an example, on property types. If you have a condo, the condo's got to be prior approved by FHA to be eligible for FHA financing. VA is somewhat similar. Fannie Mae and Freddie Mac have completely different guidelines as relates to gift funds, retirement assets, and certain income documentation. Some cases it's actually easier. Some cases it's harder. But you have to be careful, because if you run afoul of a guideline and the underwriter catches it, that's where you have your ugly surprise. Well, I didn't realize that. Well, as a lender, having done this for as long as I have, my job is to know what those guidelines are so we don't get caught off guard. If the underwriter catches something that I missed, it can be, that's bad for me. That means I didn't do my job properly.
Yeah. What I found too in the past, working with you, Keith, is that I've had buyers come to me that said, I was fully approved through another company, and I would just say, look, out of curiosity, would you mind just giving Keith a call? And Keith would dig into asking them a lot of questions that most lenders who don't have as much experience as Keith does, and he knows all the right questions to ask. And when these people would use their own lender, go to the settlement table a day before closing, the loan is not approved.
Right.
Then we're calling Keith, hey, I wish we would have worked with you before.
I think a lot of lenders sometimes are afraid to have a hard conversation with the people that they're working for, the borrowers. And some lenders are also very afraid to tell a realtor bad news. Having done this for 28 years, I work with seasoned real estate professionals, and they want to know what the bad news is. Because again, you're spending a lot of time and effort to show people homes. And those people, we don't want to have horrible experiences. Yeah. So I'm not afraid to ask, follow-up questions. Are you salaried? No, you're not salaried. Wait a minute, you're hourly? Okay, well, do your hours vary a lot? And I want to see the pay stubs. Do you get bonuses and commissions? Okay, well, I need to see your last 2 years of year-end pay stubs to see what those year-to-day amounts, because those incomes, for example, have to be averaged. You have a part-time job. Well, how long have you been on that part-time job? Is it consistent? Because you have to have a 2-year history of working a part-time job if you want to use part-time income. There's so many areas you can trip up if you make a mistake. Even looking at pay stubs. I will look at pay stubs for the deductions. What if there's a child support payment coming out and the borrower didn't disclose to me that they pay child support or alimony, something like that. Or if they're having a recurring debt that's not showing up on my credit report. Underwriters aren't going to miss these type of things. So that's part of my job, is to get the minutia and not be afraid to have a good conversation with the borrower saying, hey, garbage in, garbage out. You're honest with me, I'm going to make sure you're not going to get surprises. Half the time, if we find something that's a concern, then we know how we can work around it. Yeah. If someone tells me, I'm getting a gift from a cousin. Okay, most loans don't want to allow a gift from a non-immediate family member. But if we know that in advance, say, okay, listen, let's get the gift funds from your cousin over to a mother, father, brother, sister, an immediate family member, and then let's have them gift the funds and get around the issue of the cousin trying to give you money. Yeah. Or I'm using business funds for a down payment. Some loans have a real issue with that. Okay, we know this in advance. Let's get the money out of the business account to your personal account, season it, and get around it that way. The worst thing, most issues tend to have a workaround. The problem is if you don't find out what the issue is and you're already in the process because there's no time to fix it. The purpose of the pre-approval, find out this information up front, figure out the workaround, so now you can go buy a house and you're not going to have any concerns.
And that's so important in the market that we've just been through during COVID, where multiple offers, way over full price. You as a buyer, you want to have all your ducks in a row. And Keith, a lot of times will share either good or bad news with the buyers, and they need to be prepared. Especially, I look at writing offers on some of these listings where there's 10, 20,
Right.
30 offers.
Right.
It's like going to war, and you want to have a warrior up front,
Right.
really on the front lines, and that's why I love working with you. You know those intricacies.
Well, and you mentioned the multiple offers, and we're still, even in this market, we're still seeing multiple offers. But when the market was really hot, you had to waive financing pretty much to get a house, because you'd be up against so many other offers, and you were putting down much larger deposits to try and make your contract stand out. Well, if you waive the financing and you're putting down a 5 or 10% deposit, and then suddenly, and you weren't pre-approved properly, and all of a sudden there's an issue with your financing, you're out that money, in addition to being out of the house. I've seen cases where folks were supposedly pre-approved, waived their financing, putting down $20,000, $30,000, $40,000, and something went sideways in the financing. They lost all that money. With the proper pre-approval, you can waive the financing because you've covered all your bases, and there's nothing out there that's going to get you, so to speak.
Speaking of like down payment and funds, where can buyers find some of these monies? Sure. Can some of this be gifted?
So essentially, gift funds are perfectly acceptable with the caveat it pretty much nearly always needs to be from an immediate family member. Mother, father, brother, sister. Occasionally, if we can demonstrate a family bond, like a godparent, that can be okay. Grandparents typically okay. Where we get into issues is aunt, uncle, cousin, best friend. And that's where we need to have that discussion then. Well, how do we fix this so that we can use the gift funds? Other funds, borrowing against a 401k plan, or if you're a government worker, borrowing against a TSP. Typically you can borrow against your 401k for the purchase of the house, and there's no early withdrawal penalties. And you're borrowing the money against the funds that are invested. You're not taking the money actually out. It's not a distribution. The loans typically can be, on a 401k loan, can be put up to 15 years in most cases. And it's paid back via payroll deduction. So that's another source of funds we've had a lot of clients use to purchase a home. There's not, honestly, in our area, because it's such a high cost area, there's just not a lot of down payment assistance programs. The only program out there that works really well for down payment assistance is the Virginia Housing Grant Program. But the income limits are very low on that, and most families in this area, when you get two incomes, purchasing a home are going to be over the very low income limits provided for by Virginia Housing. There are readily available 3% down payment programs for first-time buyers that are very attractive. And we've got first-time homebuyer programs that allow incomes up to $168,000, which works really well for our area. So that someone earning still very good income can do a 3% down payment versus, say, $120,000 limitation on some other programs. So there are options, but that's where the pre-approval comes in. I'm looking at where are some ways we can get funds to help with down payment if the borrower doesn't have those monies saved on their own right.
You mentioned something about seasoned money. Explain a little how that
Sure.
can happen. And when you talk about it, the monies have to come from a direct family member, but I know I'm asking, maybe this is not the right way to ask this, but how can people get around that? Is there a way they can?
So when we look at someone's bank statements for source of funds, we're trying to figure out the source of funds are. Most programs, we're going to go back 2 months of bank statements. So if the monies were in there more than 2 months ago, I don't care where it came from. And some programs like Freddie Mac and VA, we only need 1 month of bank statements. Fannie Mae typically, though, is 2 months. FHA is always 2 months. So that's part of the conversation. If the source is coming from an immediate family member, that's easy. We can document that. We don't have to have the funds deposited early. But if the funds are coming from a source that isn't really considered acceptable, then we need to get that money into the borrower's account and essentially let it sit for 2 bank statement cycles, if FHA or Fannie, or 1 month statement cycle. And that's, again, part of the pre-approval. Those are questions we're having, conversation with the borrower. Where's the source coming from, and how are we going to document that?
Here's something, too, that comes up that a lot of buyers don't understand. And one is, before their loan is finally approved, there's a last-minute credit check, isn't there?
Oh, yeah. So
you might want to explain to people, they can't, once they get this loan process going, there's a lot of things that can get in the way of keeping them from getting a loan. So maybe talk a little about the pitfalls.
Sure. And actually, let's talk about credit in general, because there are so many misunderstandings, misconceptions about credit in general. And your credit score that we are using is going to determine your interest rate and your mortgage insurance and your program. What makes it even more confusing is what a lot of folks don't realize is that there are literally over 20 different scoring formulas out there based on industry. The credit card industry has their version of a credit score formula, which is different than our industry, the mortgage industry. The automotive industry has a different variation of that. The insurance industry has a different variation. So what happens is a lot of people think they know their credit scores because there's all these great credit monitoring apps out there, whether it's through your bank, through your credit card, Credit Karma, myfreecreditreport.com. There's tons of great resources where you can go and see what your credit looks like and get an idea of what your score is. The problem is that score you're seeing is not the score I'm going to get. And often our credit scores through the mortgage formula can score as much as 20 points lower than what you might see on the app that you're using. Because most of those apps are using the credit card industry's formula. And that's another part of the pre-approval. When I'm running your credit report, I'm running all three bureaus, Equifax, Experian, TransUnion. And then I take the middle of those three scores. And most credit monitoring apps are only looking at one bureau. Maybe they're only looking at TransUnion or Experian or Equifax. So you're seeing one score, whereas I'm going to get three and take the middle. So sometimes setting expectations is when I'm talking to a client, say, you don't need to run my credit. I know my credit score is 740. In my mind's eye, I'm thinking, well, that's one score. And if it's 20 points less, if it was, say, 720, there's a huge difference in interest rate and mortgage insurance cost if you're 740 or greater versus your 739 less. And if you're below 720, it's a big increase. It could be 0.5% on the rate. It can be doubling the cost of mortgage insurance. If your credit score is 760 or greater, your mortgage insurance is on loans with less than 20% down, you get almost a 75% discount on the mortgage insurance cost if you're over 760. Mm-hmm. If you're 759, your cost more than doubles. And that's why the pre-approval is so critical on the credit score, because that's going to tell you what the score is for your rate. And plus, when I look at someone's credit, I can give advice. I can say, hey, I noticed this on your credit report. If you change this spending habit, we can get your scores up.
Yeah, I was going to ask you about that because I was going through the same thing. I had gotten 3 different credit scores. I said, oh, my credit scores were higher than that, but you take the middle score, right?
Right.
But you had explained to our potential buyers some of the ways that they can get those credit scores up a little more in a short period of time.
So the quickest way to raise, it really comes down to credit card debt. Credit card debt is truly a double-edged sword. You need to have open credit card debt to get really high scores. On the flip side, if you're not managing that credit card debt right, it can really kill your credit scores. So I'll give you this example with what I often see. I'll give you an example. My wife always has a higher credit score than I do. And the reason for that simply is over the years, she has opened up a lot of different department store credit cards to get, you open up a card, you get 10% off your purchase, she pays it off, she forgets about the card. But she has an open card with a zero balance. And over the years, she has multiple cards open that have zero balances. My case, I don't ever do that. I have 2 credit cards, both with Navy Fed, and I only use those 2. So when someone looks at my scores, they only see 2 credit cards. They've been open forever, but only 2. My wife has like 12. She doesn't use them. She forgot about them. But the fact is they're open with zero balances, gives you bonus points. And that's how you get into like 760s, 780s, 800s. The other thing that can really hurt your scores is what they call credit card utilization. If you look at what your credit limit is versus what your balance is, if your balance exceeds 50% of the limit, your scores get dinged. If it exceeds 75%, it gets dinged even more. If you have an open credit card with a zero balance, you get bonus points for that. So sometimes everybody uses credit cards, let's be honest, for all their purchases. Nobody uses cash. And you get points and other things like that. So there's an incentive to use the credit to pay everything. And a lot of folks use the credit cards and they pay them in full every single month. But let's say you're using like an American Express card that typically don't have a true limit. If the max you've ever charged in your American Express is, say, $6,000, then that shows as your limit. But if you're rotating an average of $3,000 to $4,000 a month in expenses, even if you're paying it in full, what gets reported to the credit bureau is your ending balance on your credit card statement. What you see on your statement is what's reported to the bureau, not what you're paying it down or paying it off. So sometimes I'll see someone that might be a few points shy of where we can get into a better rate or better mortgage. I'll say, hey, you've got this one credit card that you're constantly rolling over 50% because you're using it for all your expenses. What I would tell that person is, hey, before the statement end date, pay it off. If you pay it off before the statement ending date, then that zero balance is what's going to get reported to the credit bureau, and you can get anywhere from 5 points to 20 points, depending upon how bad it is or how many cards you have. Oftentimes, I'll see clients with a bunch of little small balances, like they use a Macy's card for Macy's purchases or a Best Buy card for Best Buy, even if they're paying them off, but I might see like 4 or 5 credit cards with these tiny balances. The problem is those little department store cards often have very small limits. Like you might have a Best Buy credit card with a $500 limit and you have $250 on it. Multiply it by 4 and you could really wreck your scores and have very little credit card debt owed. So these are things I can recommend. If you have small credit cards, pay them off. Don't close them. Leave the accounts open, but pay them in full. That can help your scores. Now, the one thing that's the kiss of death for anybody with credit is the dreaded collection, especially the dreaded medical collection. That is something that will wreck somebody's scores. A medical collection for like $50, or think of a parking ticket that goes to collection for $50. That can drop your scores by as much as 100 points. The problem with collections is it's not the dollar size of the collection. It's treated as a major derogatory by the mortgage industry's formulas. So oftentimes I've had clients that have had perfect credit, and due to some emergency room visit that they had 5 or 6 years ago, and the insurance didn't cover all the expenses, and the hospitals are in the business to make money, not to collect money. So if they don't get paid by the insurance company, they send generally 1 or 2 billing statements to the client, and then they send it to collection agency. And that's the other reason we want to look at people's credit report, because I can't tell you how often we've seen these collections out there, and they can just wreck someone's scores. I always tell folks, if you're in a dispute and you're getting a bill and most time it's with emergency room visits, that's typically the one that catches people off guard. If you can, pay the bill and figure it out after the fact. If you don't pay it and it goes to collection, your credit's going to be wrecked. Another thing, good example, parking tickets in the District of Columbia or at the beach. You get a ticket, you ignore it, they're going to send it to a collection agency, and I've seen people with $50 parking tickets in the DC, think of those red light cameras, speed cameras in the District of Columbia. You don't pay it because you feel like, well, I wasn't speeding. And what are they going to do? I don't live in DC. They send it to collection, your score drops 100 points, and these things are very hard to fix after the fact.
That was going to be my next question is, when somebody does get a collection on there or a late payment,
right.
That also hurts too, even just one late payment. How long do they have to wait before you will give them a loan?
So the late payments, the way the credit scoring formulas work is they're not going to, if you have just one late credit card payment, it's not going to kill your scores. You might drop 10, 15 points, but if you've never had a late payment before and you have a one-off late payment, your scores are going to get creamed. Now, nothing happens in a vacuum. If you have a late payment and you have a lot of maxed out credit cards, the scoring formula is already stressed because you have maxed out credit cards, and a late payment might be an indication that you're entering financial difficulty, and you might see a greater score drop. If you're someone that pays off credit cards regularly, you have pretty low balances relative to your limits, and you have a one-off late, probably going to have very little impact. If you are one of these people that seem to have one late at least every year, your scores are going to stay permanently depressed. They're not going to get creamed like a collection does, but they're going to stay depressed. The worst thing that can happen to someone's credit is these collections, even more so than a random one-off late payment, because the collection's treated as a major derogatory, and it sits on there for 7 years, and you can't fix it. You need the collection agency to delete it, and it's very difficult to get them to delete the collection.
Let's talk a little. Let's change
Sure.
the subject just a little bit, but. In April of 2022, rates were about as low as we've ever seen, in the 2 to 3%.
Right.
And then 6 months later, a year later, rates doubled, they're up and tripled, they're up at 7%.
Correct. So
I was just going to ask, is it possible now, people keep thinking, hey, I'm just going to wait for the interest rate to come down lower,
right.
time the market, and see if I can just wait, and maybe explain to our folks why waiting sometimes is not the best thing, and I'll explain it in a real estate way too after you share.
So on the mortgage side, a little bit of history, just what happened with rates. So we were better from around March of 2020 all the way up to the very beginning of 2022. The Fed had cut rates to zero and flooded the market with all the stimulus money. And so mortgage rates were not next to nothing. I mean, I did some government loans at 2.25%, plenty of 30-year fixed loans, conventional at 2 3/4. Rates just unbelievable. Inflation started creeping up. And the Fed's saying this is a blip. It's supply chain issues. It's whatever. It's a wash and stimulus money. When the government stops stimulus, the problem is inflation never did improve. It went through to 4%, then 5, 6. When we started hitting 7%, the Fed started panicking. And they started massively raising the rates, and it was off to the races. We went from a period in April where we were in the low threes. They had bumped up a little bit, gone from the twos to the low threes, but still very manageable. It's funny, I was having people say, well, 3.25%, that's outrageous. By the end of December...
By the way, I've been doing this for 36 years, and I can tell you, my first house was a 13.5% 1-year adjustable rate, and it could go up 2% every year up to, I think, 21%. The fixed rates at the time were in 18 to 20%.
Right.
So when you talk about 3, 5, 7%, the average over the last 20, 30 years has probably been 6 or 7% or 8%.
Right. Yeah. So by the end of November, for example, I mean, in the beginning of December, we had gotten up over 7%. Now we started getting some inflation relief. Inflation started coming down. Like the most recent inflation report is a little over 6, like 6.9%. And rates right now have dropped to the mid sixes. The problem is that the inflation's still not under control. And we were, at one point, we were thinking, well, they will get inflation. I mean, the Fed has raised the rates so rapidly. We're at the highest federal funds levels in almost 40 years. And yet mortgage rates are still well below what they were back in the 80s and the 70s when we had the stagflation, and the roaring 80s when the economy was just way overheated. The thing about buying a house now is that, at least, like you mentioned earlier, when the rates were at the low twos, offers were insane. Escalation clauses up to $50,000, $100,000, multiple offers, having to waive financing, having to waive appraisal. Sometimes having to buy a house blind or based on a 10-minute visit because there was 100 people waiting outside to view it. And now it's not like that. Now, a home that's priced well and shows well is still going to probably sell. But instead of having 20 offers, it might be 2 or 3. Instead of escalation clauses, it might sell at list or slightly under list. I had a house recently, a beautiful townhouse up in Reston, that had 3 offers, but it sold at list and my buyer got closing cost. If that house had hit when the rates were a lot lower, they wouldn't have been able to afford it because they wouldn't have had the wherewithal to put down the $50,000 needed for a deposit and waive financing and waive appraisal and bid high. So buyers that are out there that are able to purchase with these rates, the good news is you're not facing as much competition. And at some point, one thing we've shown is if we go back to the last housing collapse in 2008, which was for a completely different reason, what occurred then, the rates for the better part of 2008 up to beginning of 2020, when there was no pandemic, were consistently low 3s to low 4s. We'd have these occasional blips where they'd jump up to the upper 4s, might hit 5, very short-lived, come back down because inflation was running 2 to 3%, but the economy was doing very well during that period of time. 2020 kind of threw everything off. With inflation running where it's at, rates have jumped up, and if they do ever get inflation under control, the Fed will be very quick to start dropping the rates again because we've shown we can have low mortgage rates and a good economy. Inflation is the key. And when that comes down, people with these 5 and 6 and 7% rates will be able to refinance. We refinanced so many people. As a mortgage company, we did $4.5 billion of business in 2021 We were the largest lender in Northern Virginia by volume. And of that $4.5 billion, almost $3 billion of that was just refinances. There's going to be another refinance opportunity. It may not be for a year, 2 years, or 3 years, but if you can afford the mortgage, you're not going to face much competition, you're not going to overpay on the house, and you're going to have an opportunity. It might be 2, maybe 3 years, but at some point, the inflation will get under control. The Fed will start dropping the rates. Mortgage rates will come down. I don't think we'll see the 2s, but certainly low 4s, mid 4s is very realistic. And people with these higher rates in the 6s and 7s will have an opportunity to refinance.
Right, and over the history of the whole lending and real estate business, I've seen these curves like this.
Up and down.
And the nice thing is over 30 years, we might have, the longest period I ever saw was from 89 to 99, I think, where we had a slow down market. But from 99 to 2005 to 2007, we tripled in value. And we've almost doubled in value over the last number of years here. I mean, talk a little about maybe what you see, where you see the market going, and what indicators should we be looking at that do affect the interest rates?
So inflation is the number one thing. We have shown rates will come down if inflation shows signs of improvement. But when inflation doesn't show signs of improvement, and what scares the Fed so much is that here they've just raised, the purpose of raising the rates is to make borrowing more expensive. For example, the housing market, it was unsustainable seeing homes appreciate almost 20% a year. It's just unsustainable. Obviously, that has been halted in its tracks. Now, values haven't plummeted, but they certainly have stabilized. That's a given. And again, the higher rates are a function of that. So the Fed accomplished something that they set out to do. They wanted to cool down the housing market. But the general economy is still rolling along. People don't realize the last unemployment report for last month, January, was the lowest it's been in over 30 years. And this is when the Fed's trying to slow down the economy. Think of all the businesses struggling for workers, because all these workers that were in the service industries that were laid off, they went out and got different jobs, And while, it gets a lot of news that the tech industry is laying off employees, because I guess someone finally realized do need to make money at some point, they found jobs in the traditional industries. So, there's only so many workers out there. There's not this workforce that, in 2008, hundreds of thousands of people were suddenly laid off, and unemployment even then got up to around 6%. People were panicking. Now unemployment's it's like 3.4, 3.6%, which is ridiculously low. Companies are begging for employees, which means they're having to raise wages. And if someone's making more money, they have more money to spend. And what does that mean? Prices continue to go up. So inflation is the watchword. Until inflation gets under control, this is just the way it's going to be. And that's why we were thinking back in in the late part of 2022, we were thinking, well, with all these Fed increases, the economy's going to slow down, the economy's going to collapse, unemployment's going to shoot up. It hasn't happened. We're at full employment, basically. Wages are rising. New unemployment claims are falling like a rock. And the Fed is beside itself because the Fed can't do anything but raise rates, so that's all they're going to do. And as long as they keep doing that, our mortgage rates, like right now, we're in these low 6s as of today. 2 weeks ago, we were in the upper 5s. It changes. But we're a little bit more worried between now and June. The Fed said they're going to continue to raise rates at least through June. Are we going to get back up into the mid to 6s to upper 6s? So again, even waiting right now, you might see, I had folks that wrote contracts in January. Their rate now is about 3/8 in rate better than what someone writing today is going to get. And if that person decided to buy in January, they've been better off.
And you brought up a good point too about refinancing earlier. What is the actual cost when you go to refinance? Just a ballpark idea.
Yeah.
Is there something you can share with people that, because everybody says, well, I want to wait, but by waiting, you're not paying that mortgage down every month.
A good rule of thumb on a refinance this is not applicable to small mortgages, mortgages under $400,000, but For your average 400 to whatever mortgage, it's generally going to run about 1% of your mortgage amount. It's a good rule of thumb. There's some fixed cost in there, which is why it doesn't work when you get into smaller loan amounts that don't decrease. And that 1% can go down the higher your loan amount is. But I'd say 1% of your loan amount. And the goal on a refinance, you want the rate to go down 1%. If the rate goes down 1% and you're paying about 1% cost, you're going to get back your money in about 12 to 18 months. So that's the goal on a refinance. What are the costs and how quickly do you get that money back? If you get that money back in under 2 years, it's a good deal provided you're not thinking I'm going to sell the house in a couple months. Obviously you don't want to refinance and then turn around and sell the house. But a lot of people, like folks sitting at 6, they might end up refinancing twice. Like you might refinance when it gets to the 5s, and then a year later you might refinance again to the 4s. We had a lot of people that I did refinances for between March of 2020 up until early part of 2022 that I've done 3 refinances for. They happen to get unlucky and get a rate at 5%. They'd refinance to 4, they refinance 3. Next thing you know, now they're going down to 2, type thing. So, it's, as long as you're getting that money back, as long as you're saving money, that's why I wouldn't be, as long as you can afford the mortgage with the current rates, you're going to have an opportunity to get a better rate in a year, 2, 3 years down the road when the rates do come back down.
And you don't necessarily have to refinance into a fixed rate 30-year loan. You can do a 15, you can do a 20-year loan. You're not locked in. That's the beauty of doing a refinance.
We can, like if someone's been paying on their loan for a number of years, we can even do 25-year term loans. So now you get better rates if you do a 20-year, very slightly lower rate if you do a 20-year term loan. And if you do a 15-year loan, typically you're going to be 0.5% better than what a 30-year fix would be. So you also get a little bit cheaper rate if you're going to a 15-year. So if your income's gone up and you want to get that mortgage paid off quicker, a 15-year is a great option for you.
Yeah. So it really depends on how long you plan on being in the home.
Right.
And the other thing is, I'm a real firm believer owning real estate is a great thing long term.
Yep.
Owning good rental properties is a great long term part of an investment plan.
Sure.
And so it might behoove you to look into picking up another property or two. Now there's a difference though, isn't there, in buying an investment property? Share with our buyers some of the things that they have to think about. If they're coming in as an investor.
Right. So in order to buy investment property, let's be honest, you've got to have a lot of cash for down payment.
How much is a lot?
So to get any type of remotely reasonable interest rate and cost, 25% down. If it's an investor condo, you pretty much are forced to do 25% down if it's a condo. If it's a traditional townhouse or a detached home, there is 20% down options, but you're looking at paying an interest rate that's about 1/2 to 3/4 higher in rate, and you're paying something called points. You might be paying an extra 2 points beyond what a primary residence rate would be. One thing that did change with Fannie Mae and Freddie Mac is when the market was going crazy and investors were scooping up properties because there's such a difference, because the rental market is still extremely hot. So investors were swooping in, buying like townhouses and condos with no intent, with the intent to rent them out because they could make money on the rental, and with values going up. Fannie Mae intentionally made it extremely expensive to finance investment properties. So that's the thing. Going in, you just have to, be aware you're going to be paying a higher rate, higher cost. You have 25% down, but the fact is the rental market's strong. If the rent covers your mortgage payment, you have someone else building equity for you. Every time you make a mortgage payment, money goes towards principal. So if the rent covers your whole mortgage payment, you're coming out ahead, and the property is going to continue to appreciate. If a property appreciates, if you put 25% down, and that a property is appreciating at just 4% per year, because the more it's leveraged, you didn't buy the house for cash. You're actually making 10 or 12% rate of return on that investment you've made in the property. And if the rent is covering your mortgage payment, it is a great investment as long as you've got the deep pockets to cover the down payment. Investment finance, investment purchases aren't for everybody, unfortunately.
What about the interest rate too for an investor?
Again, investor rate's going to be 1/2 to 3/4 in rate higher, and figure it's going to run about 2% more in closing cost on average.
Let's just say somebody's an investor, but they say, Keith, I want that lower interest rate. How do I do that? And can they live in the home for a certain amount of time?
Sure. So
and then turn it into an investment property later?
Sure. So there's nothing, as long as you occupy the property as a primary residence, that's the intent. I've had some clients that have built their mini real estate empires. They simply bought their first house, lived in it a year, moved out, rented it, bought their next house, lived in it a year, bought their next house. A lot of times they were doing somewhat lateral moves. They bought a fairly inexpensive condo. Then they moved up to a small townhouse, a little bit larger townhouse, a little bit larger townhouse, moved up to a single family. Thing is, that's how they built their real estate empire, is essentially they were buying properties they lived in. It's a little more difficult if you already own your residence. If you've got a 4-bedroom, single family detached, and you're telling me, hey, I'm going to buy this townhouse that's half the size as a primary, we're not going to believe you. This has to pass a common sense test. I've had some clients, like I had a client recently. He's got a wife, 3 children, and in-laws that live with him in this huge house in Loudoun. He's trying to tell me he's buying a 2-bedroom condo as a primary residence. Okay, are you getting divorced? Fine, I want a separation agreement and a divorce decree, because you're not buying this as a primary residence. You're not fitting 5 people in a 2-bedroom condo. But if it makes sense, someone's living in a townhouse and they're buying another townhouse. It might be a completely lateral move. You know what? Okay, that can make sense. A little bit better school district, type of thing.
Hey, something to think about too. You can buy a home as a primary residence and it can be your second home. Maybe talk a little about that, right?
So a secondary residence is defined as something that you're living in part-time and is not being rented out. That's important. If it's considered rental income, like let's say someone buys a place at the beach, and they're going to be there about a month out of the year, but the rest of the time they're going to Airbnb it or rent it out through a management company for weekly rentals. That's technically investment property. One thing that has changed on secondary residences, essentially financing has almost become untenable on those. At least because Fannie Mae and Freddie Mac, they made a huge change when it comes to secondary residences. At least on an investment property, someone's living there. It's not vacant for the majority of the year. In a true secondary residence, from Fannie Mae's perspective, that's going to be vacant. It's not being used. And when the pandemic hit, a lot of folks started buying homes as secondary residences because they could live there remotely and do their jobs. And Fannie Mae didn't like the fact they were pushing essentially local buyers out of certain markets. So to combat that, one, they made investor financing extremely expensive, and essentially they killed secondary home financing. The reason I say they killed secondary home financing is it's actually more expensive on the rate and cost on a secondary residence than a primary. So honestly, when I have someone tells me they want to buy a second home, I essentially classify it as an investor purchase because I'm actually going to get a better deal. The thing about secondary residences is you can technically still put only 10% down on a secondary residence, but the rate and the cost might be so expensive that I can't legally do the mortgage. In the mortgage industry, there is a limitation that we can charge on cost, mainly points and fees. It typically would be it's considered 3% of the loan amount. Now, these are finance costs, not like title insurance, tax stamps, escrows. Those are not considered costs from a finance perspective. But when I get above those, I can't lend money on those. Or if the rate gets to a certain amount above what market rates are, I can't lend money because it goes into what's called a high-cost loan, invites additional government scrutiny, and we're not making those type of loans. Nobody is. Nobody wants that responsibility.
So you keep bringing up a couple of companies' names, and people may not understand their part of the whole equation.
Sure.
One is Fannie Mae,
Fannie.
and the other is Freddie Mac.
Sure.
You've talked about them a lot, and these are government agencies, correct?
Correct.
What is their role in this whole lending business?
Sure. So let's start with Fannie Mae and Freddie Mac. Essentially, they're the reason we have a mortgage market. They're the reason folks can buy a home for only 3% or 5% down. What Fannie Mae and Freddie Mac does is essentially the government sets regulations for what they consider to be a quality loan. And that means everything's the same. That's where we get into debt ratio restrictions, credit score restrictions, source of funds. And the idea is that if loans meet these guidelines, it's a marketable security then. And then Fannie Mae and Freddie Mac essentially lends the money. When people go to get a mortgage, whether it's through us, a bank, their credit union, the money actually is coming from Fannie Mae and Freddie Mac. They're issuing the actual money. We're actually borrowing the money from Fannie Mae and Freddie Mac. Now, obviously, then we add on to what Fannie and Freddie's charging, and that's where our profit is. And that's where you have differences in rate. That's why our rate, for example, might be cheaper than your bank's or your credit union's rate, because we can hopefully do the mortgage with a cheaper cost. And that's why rates are not identical from one institution to not. But the money all comes from Fannie Mae and Freddie Mac, and they're setting the standards. So everybody's playing to the same rules. And that's critical, because when you're talking hundreds of billions of dollars in mortgages, there needs to be a level playing field so that the money can be readily available for someone to get a mortgage. And that's what Fannie and Freddie does. They're setting the guidelines. There's very minute differences between Fannie Mae and Freddie Mac. They're both owned by the federal government. Fannie Mae is a little bit larger than Freddie Mac. And there's some really minor variations, but the idea is, it used to be they were privately owned. When the market collapsed 2008, now what happened in the market collapse 2008 is Fannie and Freddie were still around then, but you started seeing all these subprime loans. That's where you get the people with horrible credit getting 100% financing. I once did a loan, well, unfortunately I did several loans like this, where, I remember I had one client, both clients worked for the Department of Homeland Security. Their mortgage payment was more than what they made a month in take-home pay. We did 100% financing. The credit scores were 620.
And we all saw that coming.
And now these loans were Fannie Mae. These loans were being done through private mortgage issues, and these companies all failed. And that was called the subprime market. And there was massive failures in the subprime market because all of a sudden somebody realized, wait a minute, we're lending money to people that actually can't pay their mortgages. I'm lending money to someone who works at Food Line as a cashier, an $800,000 mortgage. The idea was a greater fool theory. We're going to lend them money. They're going to own the house for a couple months, flip it for more money. The house value is going to keep going up. It's real estate. It's secure, and that collapsed. So Fannie and Freddie Mac, going back to them, they have the standards for what is considered a qualified mortgage. And if you want to, do business, you have to meet their guidelines. That's why, it's very hard if you're self-employed, writing off all your expenses. You're not going to meet Fannie Mae and Freddie Mac's requirements, and there's no thing outside of that because Fannie Mae and Freddie Mac control the market because they can buy and sell those mortgage securities. FHA and VA is more of an interesting one. When you're getting money from an FHA or a VA loan, FHA and VA is not actually lending the money like Fannie Mae and Freddie Mac is. FHA and VA is guaranteeing the mortgage. So a bank is still lending the money, and the bank is actually doing through another organization called Ginnie Mae. It's just a clearinghouse for government mortgages. But they're telling those investors, hey, we're going to guarantee this loan. If the loan goes bad, we will pay the losses on this loan. And those loans are underwritten to those guidelines. But sometimes people think, I'm getting a loan from the VA, I'm borrowing the money from the VA. Right. It's not. The VA is actually lending a penny. The VA is saying, we will guarantee this mortgage. That's why sometimes there's differences of opinion, because the VA will let you do some pretty outrageous things if you get down to it.
Yeah. That's a good point you bring up about the VA, especially in Northern Virginia and the whole metro area here. We deal with a lot of veteran loans. And maybe share with them how much the VA will allow a seller to contribute to helping our veterans.
So all loan programs pretty much will let sellers pay borrowers' closing costs up to certain limitations. On a conventional loan, it's typically 3% of the purchase price with 5% down, and that jumps up to 6%. Honestly, your closing costs should never get anywhere near 6% on a house purchase. So if you're getting up close to 6%, your lender's abusing you pretty bad. VA and FHA, they pretty much let the seller pay all the closing costs as long as they're deemed reasonable. So a couple points and third-party costs. Arbitrarily, we generally say 6%, but the fact is, if the costs are reasonable and customary for the market, they can be paid. What seller cannot, under any circumstances, pay a buyer's down payment. The down payment must always be from the buyer's own funds. A realtor, for example, can credit back some commission if they want towards the buyer's closing cost. If a builder is building a house, they can credit some money towards the buyer's closing cost. but no party that's interested in the transaction can give a penny towards the buyer's down payment. Whatever that down payment is, whether it's 3%, 5%, 20%, has to be from the buyer's own funds, or like we discussed, other sources like 401k loans, acceptable sources of gift funds, that type of thing.
I know in the past, in a buyer's market, we've had sellers pay veterans credit cards down
So
and things like that to
So
help
V-
them qualify.
yeah, VA is the one oddball loan that will let the seller pay a buyer's debt at closing to help them qualify. Now, there's a couple restrictions on that because there are limitations on that. Typically, you can't be going over, overall, you can't be exceeding 4% above and beyond the third party cost. So there are some restrictions on that. But on a VA loan, we can have a seller help contribute money towards the veteran's debts. Now that can't go, veterans obviously, most time veterans are doing a no down payment loan, so not worrying about down payment, but you could literally have a seller pay all the closing cost and some credit card debt to help that veteran purchase a house.
No, that's great. You know, one of the reasons, well, a couple of reasons why people generally buy real estate in general is the appreciation we get, the control of
Right.
over home ownership. But there's also a third reason, you know, the tax benefits. I know you and I are not tax accountants and we can't really share tax information, but when you're qualifying people, what do you share with them some of the tax benefits, if that's possible to do without being an accountant, but just share with people why they might want to consider, you know, owning real estate?
Sure. So if you're buying a property as a primary residence and primary residence only, you do get to deduct up to certain limitations based on your income, the interest that you pay on that mortgage and the real estate taxes you are paying on that mortgage. And depending upon your mortgage size, those deductions may exceed what your standard deduction would be. You know, if you're an individual, you always get a standard deduction. And if your interest and taxes exceed that standard deduction, that's an additional tax benefit to you for owning that house. So there is a tax benefit. Now, it has been nerfed a little bit with the most recent tax law changes. It's not nearly as strong as it was several years ago. But with mortgages getting bigger and bigger, prices going higher and higher, there still is a very real tax benefit to owning a primary residence. Yeah. It's not going to be a huge amount of money, but every dollar counts. You know, if you can say, if you get an extra $2,000 or $3,000 come tax time, wouldn't you rather have that? If you're paying, the biggest thing about owning a house that we always like to look at is keep in mind when you have a mortgage payment, every time you make a payment, a portion of that payment goes towards the principal of your mortgage. So over time, that principal balance is going down and you're building equity and the house value is going up. And that's why they say someone's home is their biggest source of wealth because of over time paying that mortgage principal down and the house appreciating. If you're paying rent, you have nothing to show for it. If you rent for 5 years, let's say you have a $3,500 a month rent payment and a $3,500 a month mortgage payment. Out the gate on that $3,500 a month mortgage payment, starting off about $500 to $600 is going towards principal every single month. That means in a year, about $6,000. On a $3,500 a month mortgage payment, you've contributed about $6,000 towards your principal. $12,000 over 5 years. That's over $30,000 in equity you've built in that house. If you're paying rent for $3,500, at the end of 5 years, you have nothing to show for it except a very happy landlord. Because if you're renting from a private landlord, you're building his equity for him because his mortgage is going down every single month.
And in 36 years of selling real estate in Northern Virginia and owning real estate for longer than that, I have not, maybe 1 year did I ever see rents go down.
Rents never go down.
I've seen real estate go up and down, but rents rarely ever go down.
There's just no, the fact of the matter is, this area continues to grow. We have the federal government. We have all these, we're becoming a major center for IT and cloud computing. You got these huge cloud computing and data storage sites that are cropping up in counties like Prince William and Loudoun. And anyone that does business with the federal government, whether it's defense contractors or IT or anything involving the federal government, they want to have their office and corporate headquarters here. FaceTime, lobbying for these contracts. Our area continues to grow, but there's no more land to grow on. Even areas like Stafford, Fredericksburg, Spotsylvania are exploding. It's not just inside the Beltway or even what used to be outlying areas used to be considered Prince William County, like Haymarket and Gainesville. We just opened, I work also with a builder called Van Meter Homes. They opened a townhouse development in the town of Haymarket. They started selling the properties at $480,000. Within 3 months, they had raised the prices to $580,000 and capped out around $680,000. Now, when the rates started to go up, they did drop their prices to an average of about $600,000. But the fact is, these are 3-story, 2-car garage townhouses, of which there's a million of them out there that people were paying an average of $550,000 to $650,000 in Haymarket, which isn't exactly close to DC. And a lot of those people buying those either work for the government, work for a contract that works for the government, or work for some type of IT company involving cloud computing or contracts with the government. Cloud computing, data storage is really big right now.
Keith, we'll wrap this up here shortly, but just a couple last things that I wanted to go over. There's another great reason for owning real estate is when you go to sell it, as long as you've lived in your home, and we still have this tax benefit, which I hope we continue to have. But again, we're not tax accountants, so you want to talk to a tax accountant. But as long as you live in your home 2 of the last 5 years, you get to sell that house and not have to pay a gain unless it's over $250,000 for a single person, $500,000 for a married couple. But again, we're not tax accountants. That still is a great reason why people love owning real estate in an area with appreciation like we're in. Just to wrap this up, Keith, share with me what's important in a good loan officer. What should people be looking for when they're seeking out a lender?
Sure.
And then tell us, a little about your how to reach you.
Absolutely.
And so we'll wrap it up.
I think of myself, obviously, having done this successfully for 28 years, 25 years, same company. I'm consistently in the top 1% nationally by volume of loan officers, top 1% of producers. So I consider myself to be pretty good at this. Attention to detail. I can't stress enough. It's really attention to detail and not being afraid to ask questions and give honest answers and honest feedback. Sometimes I have to tell folks, you don't qualify. I can't do this. I don't know why this person here says they can, but it doesn't make sense to me. And not be afraid of that and be extremely honest. But at the same time, empathetic and trying to work up a plan that if they can't buy now, maybe they can in the future. If I look at someone's credit and there's some concerns, here's what you need to do. If you do it, recheck in 6 years. If there's an income issue, maybe you just change to an hourly rate and you have to be on a job 6 months. Okay, well, we got to be on that job 6 months. Maybe you're changing professions. Does that affect you? The idea is to be honest and attention to detail that you're not missing anything. Looking at the documentation, getting the documentation in, saying, I got to have pay stubs, W-2s, bank statements, and just make sure you have no surprises or gotchas.
Keith, how do we find you?
Sure. So obviously, Keith Brown, Intercoastal Mortgage. Trying to think, how do people find me? Because all my business is referral based.
I know it's all. I can tell you, it's Keith B at.
My email.
Give me your email address and the best phone number.
So the best way to reach me is always my cell phone, 703-929-5274. Email is keithb, Keith, B as in boy, at icmtg.com. That's my email address. My website is simply keithbrownmortgage.com. And most of the way everything starts with me is normally we have a quick conversation about getting pre-approved or trade a couple emails. I send them to a website. They fill out a very short application, maybe 10, 15 minutes. Estimates are fine. They can securely upload their basic documentation. And then I go through everything with the clients. Here's your payments. Here's what you qualified for. Is there a budget you're working with? If someone says, hey, I want a mortgage payment of X amount, I can say, okay, well, based on your down payment and all this stuff, this is the mortgage you qualify for, and this is the price. Sometimes we can qualify someone for a much higher price than what they're comfortable with. I want them to tell me, what is it you're comfortable with? So I can tell you, here's the price range you should be looking at. But the pre-approval process, can't stress, that's the most critical part. One other thing I want to talk about the pre-approval on the credit, there's a lot of misinformation when it comes to credit. If I look at your credit report, is that going to hurt your scores? It won't. Intercoastal Mortgage is one of the few companies nationally that has the ability to do what's called a soft pull. What that means is I have the ability, when I'm running a pre-approval, to look at your credit report and not actually have it show up as an inquiry. Therefore, no one knows that you're looking at mortgage financing and no impact to the credit scores. So if someone that's worried about getting pre-approval, maybe they're just not 100% sure if they're going to buy, or maybe they're going to buy in a couple months, but they don't want to have their credit looked at, I can look at the credit using a soft pull. It doesn't show as an inquiry, but still gives me the same credit scores, the same data they use for the pre-approval. The only caveat on that is in the future when they do go under contract and they do actually go to lock in an interest rate, I must do a hard pull. That's where it does show as an inquiry. But that pull is then being used for the specific mortgage they're getting right then. But for the pre-approval, I can do a soft pull, so no inquiry and no impact to credit scores. And we're one of the few companies that can do that. Your local banks, credit unions cannot do that. And that's a big deal for getting pre-approved with us.
That's awesome.
It is.
That is awesome. Keith, it has been a pleasure. I have learned a lot just listening to you.
Sure.
Guys, if you like this kind of interview, I'd like to do a lot more of these with experts like Keith in the field. And anytime we can help you in real estate, just click on the like below. And you can reach us, Rich DiGiovanna and the DiGiovanna Realty Group with RE/MAX Allegiance anytime. And you can reach us at 571-655-3753 or anytime at richd@isellvirginia.com. Thanks for watching, and we appreciate you guys viewing us. Take care.